Hello and welcome to the Switzer webinar. As you can see, Paul Rickard is not hosting the Switzer webinar today. Paul is away, but luckily we have a much better replacement in Julia Lee. Hi, Julia.
Hi, Pete. My pleasure to be here today. Thanks for having me.
Yeah, correct me if I'm wrong, but did Paul employ you at ComSec many years ago?
Yeah, he was my boss a couple of times, once in investor education and once in premium banking investment services at CommBank. So my boss is twice over.
Okay, so you didn't work with him at ComSec?
Yes, for investor education.
Oh, okay, investor education. Okay, great. All right, so we can see from that Julia's had a very good education, and even though we do miss Paul, it's nice to have Julia with us. Before we go any further, I'm just trying to advance my screen, and it's not going as well as I should, but the wonderful Bernadette will, I'm sure, fix everything up. A disclaimer, it's really important that you recognise that we're not giving you any formal advice. We don't know your exact circumstances, but we're going to do our best to share with you what we think about some of the questions and some of the issues that you care about. But as we say, we don't know your financial situation, so you can't regard it as professional advice. You'd have to go to an advisor who knows your circumstances, but still, I think you'll get lots of benefit from being here and talking to us today. Some housekeeping. Please close all applications and programs that are not in use. Please ensure the volume on your computer speaker is tuned to a comfortable level, and you can send in questions during the webinar via the questions box. In your question, please write if you have a mic available to ask your question live, if that's something that you'd like to do. Okay, so let's kick off some opening observations and the March overview. Now, Julia, because you and I always talk about really interesting things, we were talking about the March quarter before this started, and you've done some number crunching.
Yeah, I think one of the reasons why I find these quarterly numbers quite interesting is because I've crunched the numbers, and let's say over the last couple of years, you've taken the 10 best stocks out of the ASX 200 index and simply invested your money in those 10 stocks over the next quarter. Well, in 2015, that strategy would have given you 42%, not for the year, but for the quarter. So 42% is the average return per quarter. That means if you had invested, let's say, $10,000 at the end of March last year, at the moment that would be about $40,100. So I went back and tried it for 2014 as well, and that would have seen an average return of 29% per quarter. Now, what about the reverse? You know, if you had taken the 10 worst stocks in the ASX 200, well, that would have hugely outperformed the market as well. In fact, in 2015, if at the end of March you had invested in the 10 worst stocks for the next quarter, and then at the end of the June quarter, once again, the 10 worst stocks, you would have seen a return of 23% per quarter. And in 2014, 15% per quarter, so way outweighing the market. And Peter, I think the reason why this strategy has worked are two effects in the market that are well documented, and there's plenty of academic studies about. One is the momentum effect, and if you take the best performing, there are obviously stocks with price momentum.
So you're getting on a stock that's been doing well.
Yeah, that has momentum and usually continues to have momentum. And with the worst performing stocks, these are the stocks usually where you find a lot of value because, you know, the market's overreacted in a negative sense. So you're seeing the momentum and the negative effects. So given that, you're probably interested in what are the best performing and worst performing stocks.
Well, I'm instantly thinking that, gee, the banks must be in there on the worst performing.
Actually, those numbers weren't the top 10. They were only the top 3 and the worst 3. So you don't have to buy a huge number of stocks for that strategy. The numbers do get better if you buy the top 10 and the worst 10, and that's because there's not a lot of losses, but if those losses sort of play around with your returns.
Okay, well, yeah, we're hanging on the edge of our seat.
Yeah, so the top 3 for the quarter, primary healthcare up 60%. They had a good earnings report, and you know,
this has not been a darling stock. Primary's been a heartbreaker stock, hasn't it?
And I think the reason why there's renewed interest in primary at the moment is not only because there has been a lack of impact from potential MBS changes, but also that Chinese investor who's taken that stake in the business. So a bit of speculation around a takeover for primary. Mineral resources up by 50% and CIMIC up by 43%. So you're seeing some of those real underperformers bouncing back.
Why mineral resources, do you think, has done so well?
Oh, the earnings report, I think, was quite good. And I think if you have a look at the mining services area, you can sort of divide them into companies that are exposed to the exploration stage and companies that are exposed to more the late stage of the mining cycle. And I think the late stage ones are still doing relatively well. They're stocks like Monadelphous and Mineral Resources. So they're the three best.
So Monadelphous is doing well?
Monadelphous has been doing well recently.
But stock price or profit-wise?
Stock price and profit-wise, just in the short term. Remember, it's coming off an extremely low base.
Yes, I basically had ignored it because of it. It was a great company at one stage.
But you know, if you look at the worst companies, you've got some mining services companies in there as well.
Yeah.
So, number one worst is Select Harvest, and that's understandable. I love almonds, but you know, the Californian drought is almost over, and you know, almonds are coming back to the market a lot more quickly than people thought. So almond prices have been recovering.
But it was a shocker. So therefore, if your argument works, it could
bounce
come
back. Yeah, so Select Harvest down 51% for the quarter.
Cool.
Programmed maintenance down 40% for the quarter, and Oz4X down 38%.
Yeah, Oz4X.
So there's just some ideas.
And Oz4X is a very volatile stock. And like at one minute everyone wants to buy it, and the next minute no one wants to buy it.
Look, the reason why the stock came down is because, you know, it had that takeover approach, and then that takeover company walked away, and a lot of people worried about what they saw when they did due diligence. And of course, Oz4X also came out at the time and said that business hadn't been going as well.
Yeah.
And that's because it hadn't been advertising while due diligence was happening, because of course the takeover was to occur, you know, that marketing spend really.
Okay, given that analysis of yours, which hones in on particular stocks, 10 worst, 10 best, do you think the same drivers can be used to look at like the worst sector in the first part of the year? Can that sector then turn around because it's been beaten up too much? Because that's part of your theory, isn't it? One is momentum. Everyone loves it, so keep on loving it. The other part is, we hate the stock.
Look, it's funny, in terms of sector performance, there's different drivers, and I think it depends on whether it's a risk-off or a risk-on environment. If it's a risk-on environment, the traditional growth areas are the materials, the energy, consumer discretionary sectors of the market, and if it's a risk-off environment, well, then it's going to be, you know, telecom, consumer staples, healthcare and utilities outperforming the market. So sectors perform a little bit differently, and they tend to be more macro.
Okay, well, this is the reason why I was saying, because our next question is the banks. You know, the banks have been clobbered. Nice comeback after February 10, but they've been clobbered today. What's your view on the banks?
Look, first of all, like most things in life, banks move in cycles, and their cycle is very much tied to the bad debt cycle. And you know, over the last decade, they've had this wonderful headwind, that tailwind, that, you know, bad debts have been falling. That's now, you know, at an inflection point, and we're seeing a reversal of those conditions, and bad debts now on the rise. Now this is going
provisions for bad debts.
Provisions for bad debts are on the rise. But what we probably have seen is a bottoming in that cycle, and you know, that's reflected in bank share prices. NZ share price is down 41% from the peak last year down to the trough this year. So you know, there's been a lot of wealth deterioration in terms of the banks. The question is, has the market overreacted? And in my view, the market has overreacted in the short term, so that presents a short to medium term opportunity to pick up stocks. However, in terms of the cycle, you know, these bad debts, I think, are going to be a key headwind that the banks are up against. So I think it's worthwhile dipping your toes in terms of the banks. I wouldn't be going in all at once. I'd just be starting to accumulate over time. And if I'm a longer term investor, I'd just be looking to accumulate over, I guess, a number of years, but not going in one go, because we have seen it being quite volatile. And me being younger, you know, unfortunately, I'm just seeing the banks as a trading stock at the moment, and that's because of the volatility. It's quite easy to make 10% on the banks in a period of like 4 to 6 weeks before the next downturn.
Yeah. And you're lucky, you're young and you're overpaid, so making a few dollars on stock. We should be, Julia. Now, you mentioned ANZ, and a lot of people would be, you know, wondering what our view is on that. do you think it has been belted up more than it needs to be belted up?
I think it's for a reason. You've probably heard of this cockroach theory by now, that where there's one, there's many. And unfortunately with ANZ, they came out and updated the market about their bad debt provisioning last month, $800 million. And then this month, they've come back out and said an extra $100 million. So the market's wondering, is ANZ really on top of what's going on in its business, or is there more bad news to come? And I think the difference with ANZ and some of the other banks is its exposure to Asia and the potential for bad debts to come out of Asia. And I think that's a potential downside risk for ANZ, and that's what the market's pricing in. That's why ANZ's down 41% from peak to trough compared to, let's say, Commonwealth Bank, which is down 27%.
Yeah, and an issue that perplexes me is you mentioned that the bad debt cycle is probably starting to go on the upside. But this comes at a time when the Australian economy is growing at 3% rather than 2.5%, or the 2% number that some idiots were predicting, even some bigger idiots were even tipping a recession. If we were growing slower, I could easily buy that argument. But if the economy is growing stronger than expected, well, then maybe that we're not at the bottom of the bad debt cycle. In fact, things will be better, because there are only provisions at this stage, aren't they?
Okay.
Asia and ANZ, I buy that for sure, because they are growing slower. But the local economy, the miners, the exposure to the miners to our banks is quite small. We saw that this week.
So I think maybe looking at the banks in, for example, a bank like ANZ in three parts makes sense. So one, there is the exposure to mining, and the question is how long commodity prices will stay low, and I think that's going to determine how bad things get in terms of the bad debt cycle for the banks in relation to the miners. It's not just the low commodity prices, it's actually the length of time that commodity prices spend sort of near the ground that impacts on companies. So commodity prices is certainly something to watch in that area, and if we see a quick recovery, then that would be a reason to be extra positive on a bank like ANZ. The second is Asia, and this is where I see the most amount of risks in 2016, 2017. I don't think the risks to the markets really come from Western economies like the US. I think it's more the East, which might sound the danger signals for the market. And I think it's a key reason why the Australian market's underperformed in the first quarter of the year. We have a look at the US. It was pretty much flat for the quarter. The FTSE is about the same. The Australian market was down about 4%, but that's because, Japan was down 11% and the Shanghai Composite was down 15%. So Asian market's extremely volatile at the moment. I think that's a key risk area, and that's why I'd probably avoid ANZ. And if I was looking for a cheap bank to pick up, I'd probably prefer NAB at this point in time. And look, the reason why our Commonwealth Bank and Westpac have been so strong is their focus on the domestic economy. And you mentioned it, Pete, the domestic economy has really surprised on the upside, especially the residential housing market. But now we are seeing growth rolling off there. That's one thing to really keep a close eye on with the banks because of the massive exposure.
Good point. All right, the recent Fed decision. What do you mean? It's just crazy stuff, isn't it?
I wish they would just get their messaging right, and everybody say the same thing. But at the moment, it's going to and fro. They started from 4 rate rises in 2016 to moving to market expectations. The market's really pricing in a maximum of 2 rate rises this year. But I think more than the number of rate rises is the Fed's credibility at the moment, and that's really important to markets because it also determines how effective jawboning or just the Fed talking is to impact on markets and where they want to be. It's interesting this week that we saw BlackRock joining PIMCO to say that inflation is emerging and you should be looking at hedging against inflation, whether it's through inflation-linked bonds or through gold. So I guess still the model is don't fight the Fed, and the Fed at the moment is on the stance for lower for longer, which of course is supportive to the yield trade and to risk assets, and is a negative for the US dollar, and that's why the Australian dollar today hitting, I think, over 77 US cents.
Okay, and I guess the bottom line is this, that if over the course of the year the US economy grows stronger than expected, and if Europe keeps improving at the rate it is, then the Yanks might get away with an interest rate rise without spooking the market. But I think Elon has to have that feeling that everyone thinks, well, we're doing well enough to cop an interest rate rise.
Yeah,
At the moment, there's doubts about whether it is.
I think if the US is able to see that interest rate rise, that would actually be a positive for confidence, because rates have to normalise at some point.
Yeah, without a doubt. Okay, the theme of this session today is about dividend payers outside the top 20. So, are there any standout ones for you, Julia?
Look, when we look at dividend payers, they're usually sort of in infrastructure, and that's because of the stable cash flow and the type of assets they have. And utility sectors, I guess, rife with a lot of these type of companies with high yield.
Yeah.
One of my favourites is APA. Unparalleled in terms of...
Had some good news this week too, APA, didn't it?
APA, yeah, it picked up assets from AGL Energy, the Diamantina assets, and I think that was a good move by APA, because the internal rate of return for that acquisition is about 15%. So if you're picking up assets, you're able to return those type of numbers, I think that's pretty impressive. But also the organic growth that APA has seen in its gas transmission and distribution pipelines over on the East Coast. And I prefer a stock like that to, let's say, Duet Group, which is still very much Western Australia based and exposed to that resource area, which is still doing it tough. So really liking APA, I guess, still in that area, you know, toll roads, you've got Transurban there. Sydney Airport.
Transurban's still on 4.1%.
Yeah.
And it's also a growth stock, isn't it?
Absolutely, and that's why I like these companies. It's not just about yield, because for a sustainable yield, you also need to see growth in terms of your business. And, you know, with APA, gas demand is expected to grow by around about 30% until by 2020. And Sydney Airports, you know, we've seen record numbers of international passengers through. It's basically a monopoly asset. And
4.5 predicted to go to 4.9 next year. So it's not too bad, is it?
It's not too bad. But, you know, yield seekers are all looking for the same thing. They're looking for a strong, sustainable yield with some earnings growth. So these companies, I would say, are probably fully valued. Having said that, you know, this is the type of asset you'd hold in your portfolio forever, because it's an almost monopoly asset. There's growth there. The only thing is, if we do start to see interest rates rise in the US, that could be a negative for prices of these type of companies, because they have a huge pile of debt, and that's because of the stable cash flows and, you know, the huge amount of costs it has in getting these type of assets.
What about a company like AMP? It's around 5.4%. Its share price has been clobbered because all financials have been pretty well clobbered. But it's a fairly diversified financial play, isn't it?
Sure. I mean, I like the wealth story, and if you have a look at AMP or even Macquarie Group, both of these stocks are trading like money managers. They're trading in a similar pattern to, let's say, Platinum Asset Management, Magellan Financial Group, Henderson, BT Investments. And these stocks are highly geared to the market, so as the market goes up, these stocks will do better than the market, and when there's market volatility, you know, it becomes more difficult to earn those performance
So it's
fees.
a buying opportunity on that criteria, isn't
it? If you want to trade this year, because if you do think that we are just going to see this range trading and volatility for the rest of the year, then certainly the opportunities are when the market's closer to 5,000 or under 5,000 points. But they are highly geared to the market. So just remember that when you are seeing the share price moving around, don't get too scared by it. It's just that it does tend to move more than the market on both the upside and downside.
Okay, before we start getting some questions in, let's have a look at the market and sector performance there. Have you got that chart there? You have got and so what are the standouts for you, Julie?
You know, in terms of the March returns, it's nice to see the financials thank God they bounced back in March, because for the quarter they were actually down 11%. So, you know, a nice bounce back there. But once again, I think we're going to see a lot of up and down movement. You know, the property sector has been one of the best performing in the first quarter of the year, and a lot of that has to do with revaluations that we've seen during that February earnings season to some of those commercial properties. So just watch that, because revaluations, the tide goes up and the tide goes down as well.
But I like the fact that industrials have done well too.
Yeah, well, CIMIC's the largest company there, and that's performed well. I'd just be a little bit careful about CIMIC at the moment because...
For those people who don't know CIMIC, tell us about the company.
Oh, ex-Layton's, but at the moment, there's bribery allegations, trouble getting payments from, it looks like it's Middle Eastern joint venture. So just watch it at the moment. It has been doing well, and certainly momentum is on its side. And
what about consumer discretionary in March, 5.1%?
Yeah.
Is that leveraging off the fact that retail is doing a lot better than expected? We are growing better than expected. 300,000 jobs in a year. All that sort of thing probably is behind that story.
I think some of the most positive stories are coming out of consumer discretionary at the moment. I mean, look at Premier Investments reaching all-time record highs.
Harvey Norman's been doing
Harvey Norman, JB Hi-Fi as well. I think retail's been pretty strong as long as you're hitting your market and you're growing strongly. And if you've got a good business model and you're rolling it out, then of course that's going to help support profitability.
I guess on this subject, we've got a question here from Bob with no mic. No, we'll get to Bob in a second. I'll get Michelle, no mic again. What is your view on Woolies? Because the market's been nicer to it in recent times, hasn't it?
Yeah.
Have they turned the corner? Have they fixed up their problems?
Look, I think it's going to take a while. This is not like a few months story. I think it's a few years story. And like what I liken it to is, remember when the airlines were competing against each other, Qantas versus Virgin, and we're seeing these cut price tickets, and it did neither company any good because it just wasn't sustainable.
Qantas went under $1 at one stage.
Yeah, there was a lot of troubles there, and of course the high oil price was also weighing. But
in the
supermarket space, that's what we're seeing at the moment, competition based on price. And as long as that continues, that's bad for the best player in the market and the worst. So it's bad for the whole space. So that competition and the price deflation that we're seeing, it's bad for Woolworths, it's bad for Wesfarmers. So I would be really cautious on the whole sector at the moment. I just don't see any sort of stabilisation. If anything, Coles looks like it's still taking market share there.
Yeah, and the interesting thing is there's just so much on the horizon with Aldi, and Aldi's a very aggressive performer, isn't it? It doesn't take any prisoners when it comes to big promotions and all that sort of stuff as well.
Yeah, it's an area where there are like bigger players moving in, like Aldi, as well as smaller players trying to get into the action, like Harris Farm and some of the more boutique things that you can buy online and just get delivered as well.
Without a doubt. Okay, well, I will skip the market performance in March. Let's start getting to some questions. What is your outlook for Telstra?
I just sold Telstra actually.
You just sell it because you made a fortune on it?
I bought at $5 and I sold at $5.29. I think because, how many outages have there been this year? So
3, isn't it?
3 or 4, yeah. I'm getting
But is that a sign that their demand has outstripped their capacity to supply?
As a consumer, I don't really care. I'm paying a premium for coverage, and if I'm not getting that coverage, that makes me nervous. And for me, Pete, the reason I moved to Telstra was Vodafone was having all those problems. And I was living in the city, and I wasn't getting coverage. And that was the impetus for me to move to Telstra. So no doubt that the problems that they've been having, while their whole base isn't going to move, there are some competitive deals at the moment. Some of that base, I think, is going to go away, and certainly growth is going to be harder in that key mobile area for Telstra, and that makes up about 40% of its business in terms of revenue. So,
would you buy it again at 5 if it dropped to 5?
I think because of the yield, and that's the thing with Telstra. It still has very strong cash flows. It's a giant in this area. And the fact that it didn't go into that, JV with San Miguel in the Philippines means that it has some cash and it probably has the capacity to return capital. And for income investors, that's very attractive. Yeah. And that's what's helping to support the share price, I think.
My view on Telstra is that, once again, if I saw it at 5, I'd probably buy some more. I'm not willing to sell. I'm not as aggressive as you, but I'm a bit older than you. So
yeah, my view is I don't like Telstra, but I'll buy it when it's a bargain.
Yeah.
And the reason I don't
I don't think their rivals are all that great.
No. The reason I don't like Telstra is because I like companies that are growing, and for Telstra, it's really hard to find growth when you're that mature in the marketplace and you're that big. So some of the more nimble players, they can move more quickly. And I just think it's harder for Telstra. Yes, it's got very strong cash flows, and if you're looking for income, that's probably what's attractive. But I think the next question for Telstra is, how do you get that growth without taking an enormous amount of risk? And that's the question that they haven't been able to answer.
Now, is there a smaller telco you like?
I think that telcos, there's been a huge spotlight on them, and they are pretty much near valuation. So I like TPG, but once again, valuation. Okay,
here's a written question from Bob, and it says, have commodities bottomed? My guess is yes, but it doesn't mean they're going to stay where they are at these levels. Like, I'll be surprised if oil goes below 25. Sure. But because my view on global economy is a bit more bullish than other people, but I don't think we're going to see the bottoms that we've seen in January or so. That's my view.
So two possible scenarios in my mind here. First of all, that we just see this slower for longer playing out in terms of the world, and it depends on when global growth really starts to kickstart that we start to see a sustainable case for commodities. And I think the problem with commodities is we kind of look backwards to look forwards, and I don't think that makes sense, because what we have seen in the past 16 years is unprecedented in terms of the super cycle of China, and I don't think their cycle is going to hit those type of growth levels again. It's going to be much more moderate as they move more to a service type of economy. So I think we're just looking for that cycle to turn, but I don't think it's going to happen while everyone's still looking for the bottom. No. It usually happens when no one's interested in this area anymore, no one's talking about it, and we're not talking about uranium anymore.
No. The interesting thing is that people can't get their head around the potential of India, because it's not the same beast as China. China had a communist government forcing them to grow. They got rid of a lot of their obstacles. India can't get rid of a lot of its infrastructure obstacles and its cultural obstacles as well. Yeah. But they do demand mining products, don't they?
I think in my lifetime, India is going to be a massive growth story. It's a question.
Oh, thanks a lot. I'll miss out. Are you suggesting?
In your lifetime, it's going to be a massive growth story. The question of that is timing, and often you can have the right idea, but making money from that right idea is a totally different scenario altogether. So you can be right and become, go bankrupt or go broke because, making money from that idea is very different. So I think in terms of commodity prices, you're looking for growth. I think some commodities, the outlook is better. For example, graphite and lithium. I'd be wary of some of the smaller stocks with just hype and look for, large flakes in terms of graphite, big resources in terms of lithium. So I'd probably be sticking with some of the bigger players in the market like Sierra or Rockabra. But I think commodities are still going to be volatile over the next 18 months. And if you're willing to accept that, then, maybe it is time to slowly start accumulating. The second case scenario is if we do see a shock in terms of something coming through from China. Yeah. And that would be a trigger for lower commodity prices. But I think we're more looking towards, just sort of bumping along this road until muddling along until we see some growth.
Here's a question from Giuseppe in Victoria. Can earnings outside the top 20 support dividends? I guess what you're really saying is, can we rely on them being reliable dividend payers?
Yes, absolutely.
Yeah, I think so too.
I think it depends on the type of
some really good companies have a good history of paying dividends.
Oh, yeah, absolutely. And certainly we've seen that throughout the last couple of years where it has been the mid-cap index and the small-cap index which have provided not only capital growth but also some strong dividends as well.
Yeah.
And it's not unusual in this space to, find yields between 6 to 8% only because the rest of the market isn't looking. And unfortunately, because there isn't a lot of coverage in this space, it means that you do have to do a bit more work there.
But that's what the Switzer Super Report is supposed to do.
There you go.
And Bernadette, we have actually a couple. I'll make sure we'll cover even more to make sure Giuseppe has a happy investing experience. Here's a good one. because all related to Woolworth. Is there any hope for Metcash? I looked at the brokers just for Dean's sake. It's $1.72 today. The target for the brokers is $1.65, and the Senate indicator is 0. It's not minus, but it's not great.
Look, Metcash has, done well over the last few months, and it's recovered, but at the prices that it's at, I think it's too expensive. So at these levels, I'd be more inclined to sell and pick up at a cheap price later down the track. And for me, not only is it about the things that we've been talking about the pricing wars, price deflation, and Coles and Woolies in this war, but for me, Metcash is about the lack of scale. And in this business, when you've got a pricing war, it's about scale. You look at Woolworths' sales, it's $44 billion. That's compared to Coles, which is $39 billion, and Metcash is down there at $13 billion. So, the big players are Coles and Woolworths.
It's like the small banks versus the big four.
Yeah, so I think they compete more in terms of convenience, in terms of their location.
And relationships, and people often will like their IGA store, and therefore they look past the price. And I think people who shop in Paddington, in the IGA store there, well, they could go down to Double Bay, but they can afford not to. But there are those sort of special reasons.
I mean, where I am, we don't have a Coles and we don't have a Woolworths. But sometimes when I go to IGA, and I like IGA, I don't get everything I need there. Like the fruit and vegetable selection isn't quite as diverse, and the meat as well. So what I find is that I pick up things that I need during the week. But, if they're going, one time I went and, my Bellamy's baby formula, which retails for $28 on the Bellamy's website, was selling for $37. So, I go to the Coles or the Woolworths store and I go for a drive and I buy everything in bulk and I bring it home.
That's part of the challenge that Metcash has got. Okay, let's have a look at some other questions that have come in. This one comes from Harold N, no microphone again. What are your thoughts on sell in May and go away? Do you think this will happen this year? For those stocks that you like, you probably think they can actually resist it.
I've actually crunched the numbers behind the sell in May, go away for a number of years, and really there's no basis to it. The years that it happens, we talk about it all the time, sell in May, go away. But then the years it doesn't happen, we just ignore it. So there's no statistical significance in this sell in May and go away. And the thinking behind it is that you sell in May and then you buy back sort of Halloween.
St. Ledger's Day.
St. Ledger's Day,
yeah, which is September 14th. So it was the old saying was sell in May, go away, come back on St. Ledger's Day.
Oh.
And the reason was, and probably why it's not relevant so much now, was that was the period of the UK summer. And so the stockbrokers would basically go on holidays with their kids, and St. Ledger's Day is a famous race day when they all got back together, probably at Ascot, I could be corrected on that one, and that's when they were back in town. So the city resumed its activity. Isn't it interesting?
How funny, yeah. But, this year I think is going to be one where investors do need to be nimble, and in times of volatility, this is where the opportunities are. So if you can pick up stocks at the lower end of the range, I think that's a good strategy for accumulation this year. I'm not good with losing money. I'm terrible with losing money. I get very upset, even in the short term. So my number one thing in all markets is capital preservation first, and then making money second, because in my view, you can't make money if you don't have the money. So I do tend to be a little bit more conservative towards losses, and while I like getting a bargain, I'm not very good at watching it go down. So from some of the things that I do, this year I've told myself I'm not going to buy anything that's going down. I'm going to wait till it goes up, and I'm not going to sell anything.
So you're going to get on the trend.
Absolutely, and I'm not going to sell anything that's going up, because I sell too early, Peter. I bought Bellamy's at $2.20. I sold at $4 thinking I did a great thing, but then, watched it go all the way up. So not selling, when it's going up. And the way that I'm putting
So you will sell after a couple of weeks of going down, even though you might take a loss.
Yeah, and because I do get emotionally attached.
Trend
I love my stocks. I do get emotionally attached to my stocks. I just put in trailing stop losses. That takes the emotion out of it for me, and that means as the stock's going up, the stop loss price is going up as well, and then as the stock price goes down, that stop loss gets triggered. And so.
Okay, well, that's a good technique. I never thought you'd be so emotional, given the fact that you love money so much that you'd love the stocks. But
I
still,
do. I love the stories behind it as well. And of course, free conditional orders through Bell Direct. You just pay the normal brokerage costs if they get triggered. So you can put on as many as you want on your portfolio.
Well, you deserve a free plug, giving up an hour of your time to help us today. Lynn Boyle, no Mike, would you buy BHP at this level? Let's assume you were a long-term investor as opposed to a trader. I'd say Lynn's probably more likely to be someone who wants to put BHP into her self-managed super fund and maybe hold it. Is this a good level?
It's hard because BHP has rallied quite a bit. I would probably be comfortable accumulating BHP at the moment.
In the 16s.
Yeah.
14s would have been better, but 16s.
Yeah, but if it gets to sort of about 15.50, I'd probably just be out again and wait till it bottoms. Only because I do get really nervous, and I'm not the type of person that
You won't dollar cost average?
No, I don't have the courage for that. But investors that are more courageous in terms of that longer term view, that's certainly a way you could accumulate stock in BHP. It's just not the way that I prefer to do it in the environment that we're in, because I'm a bit of a nervous Nelly.
My most memorable dollar cost average nervous play was, pre-GFC, had Macquarie at 42. When I saw it at 23 during the GFC, I went back with my ears pinned back, and when it got 16 or something, I hated myself. I knew the treasurer was going to come in and save them anyway, and it did. But boy, that is really annoying when you get in and you see it drop another $6 or $7.
Yeah. I mean, there are stocks where I will take I will watch the stock price go down, but that's where I am, so confident that the market's got it wrong. And one of those companies was TFS Corp, this sandalwood company that was on a PE ratio of 3 before its results. And, there was growth, there was larger harvests coming, and, it takes 12 years before you can start to harvest the sandalwood heart, which...
So the analysts just got it wrong.
Sandalwood oil. No, the market got it wrong. Most analysts had a target of double the price or more of where it was at. So I was willing to watch that go down to $1.20, and I'm up 30% on that position. But that's where the fundamentals I am so confident about in terms of growth. And with BHP, it's not a question around growth. It's a question around valuation, and that's where you have to be careful about the value trap.
I think the longer you've got to wait, BHP is not a company that's going to disappear.
No, it's not going to disappear.
And it's not a company that's going to be a $16 stock forever. It's going to be in the 20s, and it'll eventually climb to the 30s, but it might not go higher than that. But that's going to take time. What about this one from John Selby? He has a mic. John, do you want to join us? We'd love to hear your voice.
Hi, John.
Hello.
Hi, how you doing?
Ask your question.
Good, thanks. Yeah, it's a quick question on Telstra. I'm seeing a lot of the money coming in from NBN into it. I'm not seeing, certainly my experience with Telstra has not been great in its investments. I watched them go into Singtel about 15 years ago, which was a disaster. What's your thoughts? I mean, I'm not seeing them particularly doing well with their cash. Is it going to become a problem? I mean, they're not continuing to be the biggest player in the telco, and it's gradually being whittled away by the smaller guys, TPG, etc. What's your thoughts?
Look, I think if you're in regional Australia, Telstra's sort of the only game in town, but I think the NBN does transform the space a little bit. It means that there's more of a level playing field, and when you level the playing field, it's always worse for the big players and better for the smaller players. In any area usually of the market, and that's a general rule of thumb. So it will become, I guess, more difficult for Telstra. Having said that, the positives are the massive amount of cash flow it has at the moment, and if it can find a use for that to generate greater returns, then that would be a positive. But I admit there isn't a big great track record.
Yeah.
And when you're looking at a company the size of Telstra, the type of investments that you have to make and the size of the investments means that there's considerable risk to that stable cash flow.
Yeah. John, my view is, I shared it with Julia earlier, if I see it in the low 15s, I could nibble in. To me, Telstra is a reliable income payer in my portfolio. I've got it at a good average price, and therefore the yield's nice. But I can't get excited. But on the same point, because it's a 64,000 pound gorilla, it does have the opportunity to mute their smaller rivals if they really want to get serious about it. We've seen what Qantas has done recently compared to Virgin, and Qantas has really rebounded, and it looked dead on its feet, a couple of years ago. So your point on the NBN is an interesting one, but I think NBN is also an opportunity for it. It just depends on how good Andy Penn ends up being as a CEO. And I think the jury's out on it, but he hasn't had enough time to be responsible for those outages. I guess we should be seeing nasty notes to David Thodey on that one. But as I say, I still think it's a reasonable play for people chasing yield. Okay, another question, and this is Raman Naidu, no microphone. Would the fact that Australia's ethical foundation is removing APA from its portfolio affect its price for a long time?
I wonder why it's removing it. On an ethical basis or just from a portfolio basis?
I haven't come across that story, I've got to say.
Okay. For me, no. I think the assets are unparalleled in Australia, and holding those assets, I'd be pretty happy to do it for a long time.
Yeah, it may well be responsible for a small blip, but I think if APA becomes more price attractive, there will be people out there who will snap it up.
Yeah, I mean, I like APA in terms of its debt. It's more conservative than a company like Duet Group, and where else are you going to get infrastructure like that here domestically?
Yeah. It's a good question. I actually will follow that up on the show to see why the Australian Ethical Foundation have dropped them. Because I just can't see any reason why, but we'll find out and we'll look into it.
And if, a big holder of shares is selling out when I'm positive, I see that as an opportunity to pick up.
Okay. Here's a question from Hugh in South Australia. My question relates to using ETFs versus buying shares in well-known companies. I prefer direct investments and enjoy researching companies, but our SMSF advisor and accountant says research shows most investors underperform the market index and recommends ETFs. We have now started buying international stocks on NAB trades and are pleased with the results. What are your thoughts? Julia?
Okay, so a few thoughts on this one.
Do you ever buy ETFs?
I do, mostly to get international exposure to markets where I'm not familiar. Where I am enjoying companies and researching, I prefer direct investments as well, but certainly in areas that I'm not familiar with or are not in my time zone, then I'll use ETFs to gain exposure to those different asset classes and those different markets. I think ETFs are a good low-cost way to get into different assets. However, having said that, a lot of those studies saying that ETFs outperform, managed funds, there's studies that have been done in the US, and I think in Australia, actually, active management does outperform. So our fund managers do a pretty good job.
Because the American analysis showed 1 in 3 active fund managers can beat the index. That means that 2 out of 3 don't. And it also showed that the fund managers that beat for some period of time, they might not. So they consistently beat. So I have come across on an Australian basis that a lot of our active fund managers, there may well be 1 in 2 outperform the index. So the question is, have you got the ability to find the fund managers who consistently have beaten the index? And that should be the critical analysis.
And like any investment, you diversify fund managers as well to diversify that risk. But I hear that quoted a lot, and I think it is in relation to the US market that those numbers are crunched, not in terms of the Australian market. So that's one thing to be aware of. The other thing is, you take the performance of these fund managers, and what you do get is a normal distribution, which effectively is the market.
Yeah.
So you get the market, and then you take into account brokerage fees. Then, of course, performance is going to be less than the market. So, just intellectually, that type of thinking,
And I can see some people maybe taking the ETF for the ASX 200 as a base and then picking out, say, a small cap fund manager to give them access to that, and maybe an international fund manager like K2 to get overseas exposure. I think you can mix them up, but for your accountant advisor to generalise and then say you shouldn't do it, well, that's something you've got to decide yourself, Hugh. And maybe you could do half and half, a bit ETF and also, well, maybe a half and half if you're a conservative investor. I know a lot of my friends will do ETFs for the core, but take 20% and play direct shares.
I mean, if Hugh prefers direct investments, then, and if he enjoys researching companies, then I'd say go with what you enjoy and most people, go with ETFs because they don't want to think about their money. Yeah. But, Hugh, you're the opposite. You like thinking about it. Then, and if you're getting enjoyment out of managing your own portfolio, I'd probably, if it was me, I'd stick to that.
Okay, so there's Julie's advice. Okay, so we've got a couple other questions here. This one comes from Elise Tamir. Is there any hope for Capital Health? And she has a microphone. Elise, do you want to join the group?
Yes, thank you.
So what's your view on Capital Health?
My broker advised me to buy Capital Health some time ago when it was going up. Mm-hmm. I'm now $30,000 down.
Oh, okay.
Gee.
And it's in my self-managed super fund.
So
I don't know what to do.
Over what period of time has it been sliding?
Oh, must be about a year.
Yeah, since about March of last year when the market went off the boil.
Yeah.
Do you have any specific views on Capital? I've noticed that, copying it on some of the worst performers on Sky, but what's the story behind it, Julia? Do you know?
So it's predominantly has diagnostic services over in Victoria. So it's radiologists mainly. And I think when you look at a company like Capital Health compared to, let's say, a pathology company, with pathology, someone takes a blood, but then it goes to a central base and it's analysed. And there is some, I guess, logical thinking in acquiring more of those collection centres because then you can cut down the costs in terms of the central processing. But with radiology, it's very different.
Very labour intensive.
It is labour intensive.
And very expensive capital equipment.
Absolutely. So to expand, it's not just a matter of, getting sites. You actually have to pay for these radiologists as well. So it's a little bit different. But what's been impacting on Capital Health has been the potential changes to the Medicare benefits.
I was going to say that. Sounds like a regulatory issue.
Yeah, but also it's already started to see deterioration in terms of earnings. And the thing with Capital Health is it's this roll-up model where it's been on this acquisition trail. So it has a large amount of debt. And I think that's a problem. Debt's not a problem when the business is going well. It just means that the business can grow a lot more quickly. It is a problem when the business isn't going so well as it is with Capital Health. So I guess at these type of prices, I think you've been through most of the pain. I'd be even inclined to start picking some up now because it's looking relatively cheap in terms of its risk to return profile. But the regulatory risk is still there because we don't know exactly what's going to happen. And the thing is, even before that regulation gets into place, it actually does impact on its business. I mean, I went to get a blood test a couple of months ago and my friend just said to me, you're going to have to pay for that. I said, no, that hasn't come into effect yet. That's just proposed changes. And they're like, no, it isn't. You're going to have to pay for that. Of course I didn't. But when I went to get my blood taken out, and I'm a bit of a hypochondriac. I've got elevated blood sugar, so I go get blood tests quite often. First time ever, no line, straight in. There's no one there. It was just me.
And were you charged?
No, of course not, because it's a proposed change that hasn't come into, but it's already affected people's thinking around, on whether they're going to get these.
I'll tell you what, Les, I'll try and get the CEO of the company on TV show, all right? And we'll follow on that. Yeah, I'll be interested to see what's going on there. Okay, Peter Beaconsfield, he hasn't got a mic. So what do you like in tourism and leisure? Now let me throw this in. 2 weeks ago when we did the Switzer Strategy Investment Day, Charlie Aiken did a presentation around 6 or 7 themes that he liked. And one of the ones he liked was the rise of the Chinese international tourist and how that's benefiting Australia. And he actually does like the tourism and leisure sector. And one company I know he mentioned was Star. He likes Star. You might, have you ever noticed, Julie, that Chinese people like to gamble? Have you ever come across this little observation?
I don't know.
No, you haven't noticed? And also, I think Mantra Group was also mentioned as a company that could be a beneficiary of this sort of thing. Crown, potentially. Crown always worries me. I'm not strong on Crown. But certainly there were 2 companies that Charlie mentioned in his presentation. So what about you, Julie?
Well, international visitors are at a record, and Sydney Airports has been going very well. We've mentioned that one, SYD, and I think they'll continue to do well. Same with Auckland Airports.
Someone asked a question about Badgerys Creek. Could that hurt Sydney Airport? But Sydney Airport has first rights over Badgerys Creek.
That's right. So it might be a good way to expand.
Yeah.
Mantra is a good one. I also like the corporate travel area. That's been doing quite well. So CTD is corporate travel. Qantas has been doing very well out of its corporate customers as well. Virgin's probably one I'd avoid at the moment, only because Air New Zealand's looking at selling its stake, which means one less shareholder to get funds from, and the actual business is pretty much struggling. They've been selling its fleet and trying to get its balance sheet in order.
Despite the fact that business class travel has been doing well, that's part of the story. But
I think just watch Virgin, because it is also a potential takeover target if Air New Zealand sells its stake. So watch Singapore Airlines and Etihad to see whether they make a tilt for Qantas.
Yeah. Okay. So that's we certainly like that sector, and probably like it more when the dollar's low, but still, even at these levels, it's not.
No, I think
not high for the
Australia's a popular destination for the rest of Asia, so I think that's going to continue, and those tourism stocks are going to do well.
I also think in the age of too much European terrorism,
travel
Australia,
domestically.
The lot of domestics, and also I think will be attractive as well to other people who want to travel. George, your thoughts on gold?
Mine. I like gold. I always do this. I bought a gold nugget last year.
Did you? How much is that worth?
This is about 5 grams, so it's probably about $500. It's tiny, but it's really heavy.
Yeah.
But gold is often thought of as catastrophe insurance.
That's Julia's nugget.
And I think
it's not a neat nugget.
I like a nugget because it's rare. Most gold occurs in veins now and is melted down into bars. So to find a nugget, it's actually more difficult. But I think if you do think that we are going to see volatility this year, I think that's going to be a good environment for gold prices, especially if we see lower for longer.
But how do you play gold? Do you buy stocks, or do you buy? We sure got a nugget, but do you go for the commodity or the company?
Yeah, I've diversified not only into gold companies, so I have Regis and St. Barbara mines in my portfolio, but also I have physical gold as well, so I have a little gold.
Because sometimes you can get the commodity price right and the company lets you down for other reasons.
Yeah, I mean, the Aussie dollar price of gold has been phenomenal in 2016. I think this has been the best quarter that we've seen for gold prices. I can remember.
When currencies fall, that helps, doesn't it?
Yeah, so the Aussie dollar gold price has been doing extremely well, and technically gold on the New York in US dollar terms above the 200-day moving average and moving quite nicely.
Okay, that's Julia, and I've got to say I just don't play gold.
A lot of people don't.
I don't understand gold.
And I think that's a positive, Pete, because what we have seen in 2016 is there has been money moving into gold. I think it's a lot of money managers who don't usually hold gold, who've started to think about gold. And if you think about it, if weightings just went up by 1%, that would have a massive impact on gold, because you can't readily get access to gold. You have to dig it out of the ground and find it.
And the thing is, gold prices go well when you fear inflation or you fear a recession. Now, both fears are out there at the moment, aren't they?
Yeah.
Okay, let's go to William Granger, and he has no mic. Do you think Aldi will be larger than Metcash? Hard to say. They're aiming for 565 stores, aren't they? They're about 365 at the moment.
I'd say that in terms of sales, I guess it depends on over what time frame, possibly over the 10-year period, but yeah.
It's a question I really haven't got an answer for. Certainly I think they will make life hard for IGA because they kind of compete in the same kind of space, don't they?
Yeah. I mean, the stores tend to be bigger, more heavily discounted, and I think IGA, while it has a lack of scale, it competes less on price and more on convenience.
Well, we'll leave that one. We're not sure what the answer is to that.
I think possibly, but it depends over what time frame. Not over the next 2 to 5 years, I'd imagine, but when you're looking at a 10-year period, possibly in terms of sales. Okay,
this one's from Nyan. No microphone. Any views on Eureka Holdings?
No.
No. I'm sorry about that, but Nyan, I'll get Bernadette to send me an email, and we'll see if we'll get someone on the TV show to talk about Eureka Holdings. We have one here from Ian Fleetwood. Okay. Noisy environment with grandkids, so he doesn't want to use his mic. Fair enough. I have a self-managed super fund and have just retired, looking for a long-term income. My dividend strategy is being challenged at the moment. Should I consider short-term trading?
No. I think the shorter the time frame, that it can be a bit more difficult. The type of the market that we're in at the moment, I think suits shorter-term traders. I tend to like to buy and hold my investments, but I'm just finding it difficult to do it in the type of environment we're in. I wish we could go back to the 2003 to 2007 period where everything I bought just magically went up. But this environment, I think you have to be a little bit more nimble. But to go from being an income investor to a short-term trader just because you're sick of your investment's not going too well could be the wrong reason to move into short-term trading.
Yeah, I always say that if you are looking for long-term income, you really should be buying companies that have a history of paying good dividends when the market is really mad and silly, like it was in January. Some really good companies actually, their price fell, the dividend yield went up, but they weren't like BHP where the price went down, the yield went up. It's not a reliable income dividend payer.
Yeah, I think you've just hit the nail on the head, Pete. What you're looking for with a dividend stock is for earnings to remain stable or go up. If earnings are falling, then it's likely that the dividend will fall at some point as well. So for a dividend stock, you're looking for not only that great yield and the dividend payout ratio, but you're also looking for that earnings growth to come through too.
I'd like to share with you, it's Ian, a friend of mine who always bought great quality dividend paying stocks whenever the market was really at its worst.
Yeah, that's a good way.
He's now in his 70s, he retired with $5 million in his self-managed super fund on an average yield of 10%. So he's getting $500,000 tax-free.
And some of those assets that we talk about that are near monopoly assets, Sydney airports, Auckland airports, there's great demand, but when you do go through periods of turbulence and they are hit, well, those assets are going to be around forever.
Yeah, and the thing is this, during these bad times, if the stock market does see 6,000 in a year or two, a lot of those good dividend paying stocks will go up, not at the same rate as industrial growth stock, but it'll go up, but you have bought the stock at a good price, your dividend yield will be lovely, and you'll be smiling. So the fact that you're not smiling now doesn't mean you won't be smiling in the future if you buy good quality companies. One last one before we go, and there's always going to be someone who asks this question. This is Delhikar. He says, is there any prospect for Slater & Gordon bouncing back?
Okay, I think this one is just simply a binary outcome. I think this week Slater & Gordon...
Explain what you mean by a binary outcome.
you're either going to make a lot of money or you're going to lose everything with Slater and Gordon. That's because this week they had to present their plan to their bankers, so their lenders, who are holding all the cards at the moment because the amount of debt that Slater and Gordon has and the earnings pressure it's under, to turn around its business. So at the moment, it's at the mercy of its bankers and its lenders. No, I haven't.
Yeah, okay. Now, and she's a thrill seeker, but she doesn't like to lose her money. So it's a very interesting take. I wouldn't touch it, quite frankly. But I'm not a big speculative investor. I like to buy quality
you're not
companies.
looking at the company bouncing back. You're looking at a decision the lenders are making. So I can't predict what they're going to do.
That's right. Good point. Julia, thanks for joining us.
My
it's been
pleasure.
a pleasure.
Thanks,
in fact, I've enjoyed your company much more than Paul, Rick. I'll forget with Paul, I think. You're much more enjoyable than Paul, but maybe I get too much of Paul. Ladies and gentlemen, thanks for joining us on the Switzer Super Report webinar. Thank you for participating in the webinar. I look forward to talking to you in a month's time.